Welcome to Talk Tickers. Today, we're digging into a huge question. Does the inverted yield curve, one of the market's most famous recession predictors, actually still work?
So to really get why this thing is so legendary, you have to look at this quote from the San Francisco Fed. It says it all. Every U.S. recession in the past 60 years was preceded by an inverted yield curve. I mean, think about that. Every single one. That's a heck of a claim. And it's the entire reason the yield curve got its reputation as this almost magical economic oracle. And look, this isn't just some academic theory. The track record is just incredible. For decades, this single signal has been almost perfect. We're talking all 9 U.S. recessions since 1955, called in advance. There was only one false positive way back in the mid-60s, and even then, the economy did slow down. That kind of accuracy is exactly why Wall Street hangs on its every move.
Okay, so what in the world is this thing? To really understand why it's been so powerful, we've got to pop the hood and see how it works. So let's break down the mechanics.
All right, so here's the basic idea. An inverted yield curve is when, bizarrely, the interest rates on short-term government bonds pay out more than long-term bonds. Now, that's completely upside down. Normally, you'd demand a higher interest rate for locking up your money for, say, 10 years compared to just a few months, right? Well, an inversion flips that entire common sense logic on its head.
And the difference between normal and inverted is, well, it's night and day. A normal, healthy curve slopes up. Long-term bonds have higher yields. Everyone's optimistic. Banks are happy because they can borrow money short-term for cheap and lend it out long-term for a profit. That keeps the economy humming. But when the curve inverts, bank profits get crushed, which can make them pull back on lending, and it sends a huge signal that investors are seriously pessimistic about where the economy is headed.
So how does this even happen? It's really like a chain reaction in 3 steps. Step 1, the Fed starts hiking short-term interest rates to cool things down or fight inflation. Step 2, investors see this and think, uh-oh, these rate hikes are going to slow the economy, maybe even cause a recession. So they start betting the Fed will eventually have to cut rates way down the road. And that leads to step 3. To protect themselves, they rush to buy long-term bonds right now to lock in today's higher yields before they disappear. All that demand pushes long-term bond prices up, and that pushes their yields down. And boom, the curve inverts. It's basically the bond market saying it has no confidence in the future. And again, this isn't just something from a textbook. Let's look at the actual history, the proof that built this indicator's untouchable reputation. Just look at this timeline. 1980, 1990, the dot-com bust in 2000, the Great Financial Crisis in 2008, and yep, even the flash recession for COVID in 2020. Before every single one of these downturns, the yield curve inverted. It has been the most reliable smoke signal the market has for an approaching fire.
Now, it's not like a switch that flips and a recession starts the next day. Historically, there's a lag. The time between the first day of inversion and the official start of a recession has been anywhere from as short as 6 months to as long as 2 full years. And that huge range is a really key part of the debate that's happening right now.
Which brings us to the big, giant puzzle today. Has this thing finally broken? The yield curve has been inverted since July of 2022. That is the longest stretch in history. And yet, that recession everyone was so sure about, it's been a total no-show. So this is the question that's on everybody's mind. If this indicator is so good, where's the recession? It's kicked off this massive debate. Are we finally in a this time is different scenario? And as you know, those can be the most dangerous words in investing. So let's run through the counter-arguments because they are pretty compelling. First, maybe the curve is inverted not because of a coming recession, but because investors just think inflation is going to fall, which means the Fed can cut rates. That's a good thing. Second, some people argue the real alarm bell isn't the inversion itself, but when the curve starts to uninvert and go back to normal. That's the real moment of danger. Third, maybe today's economy is just a total outlier. We've got this incredibly strong labor market that's acting as a buffer. And finally, you have to wonder, has the yield curve become a victim of its own fame? Maybe its power is fading simply because everyone is watching it.
Okay, so what does this all mean for us now? How should we be thinking about this signal going forward? Let's try to pull all of this together. You can really break it down into the bear case versus the bull case. The bears are shouting, look at the history, 60 years of perfection, you don't bet against that. They also point out that recessions often start after the curve uninverts, so maybe the clock is still ticking. But the bulls are saying, hold on, this time really is different.
The inversion is about falling inflation, not a failing economy, and our strong job market is a shock absorber we didn't have in other cycles. The real takeaway here is you absolutely cannot ignore the track record, but you also can't ignore the very unique economic situation we're in today.
It all boils down to one single critical question. The next time you see the yield curve is inverted, you need to ask yourself this. Are investors betting on lower rates because they see a recession coming over the horizon, or are they just betting on lower rates because inflation is finally getting back in its box?
Because the answer to that question is everything. It's what separates a flashing red warning light of economic pain from a green light celebrating successful policy. And that is the key distinction. This is not financial advice.